First of all, Happy New Year. It's getting a little late now to say that, but I'm still going to tell you Happy New Year. Hope you all had a wonderful Christmas season, and here we are in 2025, believe it or not. All right, so today, here's the quick agenda, and I want to be respectful of your time. We're going to talk about this upcoming year, what we're expecting, some of the things that may be some challenges or opportunities in this upcoming year, and essentially how to navigate it. So with that said, I'm going to share my screen and we'll get started. All right, so here we are, 2025 market outlook. For those of you that have been in these presentations before, the first thing is obviously that we're going to say, please don't act on anything we say. This is educational in nature. Let's make sure we get one-on-one to specifically discuss anything that's particular to your situation. But hopefully today you'll learn something. I can't vouch for the entertainment value, but hopefully you'll walk away having learned something. Before we get into the market outlook, I chose to throw this at the very beginning because usually I end up at the end and I'm just kind of rushing through these, and then Steve doesn't like that, and so I wanted to hit these first. So a couple things about, obviously we're in a new year. A lot of times the tax rates or limits change at the beginning of the year. So this is a quick rundown of the new IRA and Roth IRA contribution limits at $7,000. The 401k contribution limits have gone up to $23,500. And then there's this new phase of different catch-up provisions at different ages. Again, I'm not going to go too detailed into this, but if you're within those age ranges, you now have additional catch-up amounts that, if the plan allows, you can do. The SEP IRA limit is still 25%, but it's up to $70,000 now. And then the tax brackets, all of the individual and married, filing jointly, all those tax brackets have been adjusted up, which essentially means that more of your income will be in a lower bracket. It's essentially an effort to help against kind of the inflationary environment of your income. Social Security benefits, those increased this year by 2.5%. The Social Security wage base, which is the amount of your earned income that is taxed with those Social Security taxes, that's at $176,100. Social Security Fairness Act, this is something that came into effect recently. It really doesn't apply to a lot of people, although there probably, in fact I know one or two of you on this call that it does apply to. There's a windfall elimination provision that was happening with certain retiree benefits when you had other non-covered pensions, and it eliminated a pension offset for government pensions. The annual gift exemption is now $19,000 per year, and then the QCD, or the Qualified Charitable Distribution, which a lot of you take advantage of, is at $108,000 this year. However, again, that is, you have to be 70 and a half years old. I know I hit that real quick, but do not be dismayed, because on our website, at the very bottom, we've updated. So if you go to counterweightpw.com, go to the very bottom, and you'll see our 2025 Key Numbers Guide. When you click on that download button, we don't make you enter your email. We don't make you log in or nothing. No, you click on that button, and our key numbers pops up. So much thanks to Steve Swarkowski for putting this together. Much thanks to Marianne Standish for kind of making it happen too. But that's important. I want you guys to use that resource because it really is a fantastic quick reference guide. All right, so here we go into the market and the economy and everything you want to know. As I've done every year now when we do these January market updates and outlooks, I really like to start with kind of our frame of reference for how we entered the year. What I find is that we are so, as people, as humans, so often so forward-looking that we kind of forget where we've came from. We forget all the good things that have happened. We forget all the fears that never came true. We forget all this kind of stuff because we're so focused on what's next, what's next. And I just find it a good practice to say, where were we at? What did we foresee? And then what did actually happen? So if you remember, 2022 was a bad year. 2023, we had a big recovery year. S&P 500 was up 26+%. The NASDAQ was up over 44%. All across the board, it was a good year. So we entered 2024 again with a lot of list of concerns. And so this literally is taken directly from a year ago, and these are the concerns that we laid out that was on everyone's mind. We were seeing the fastest pace of interest rate increases in history. Lots of questions about, wow, we had this big run up in 2023. Are stocks overvalued? There's recession fears that are still out there. There was a war in the Middle East. Remember October 7th of 2022 or 2023 was the terror attacks into Israel, which started a war in that region. And oh, by the way, we were entering a presidential election year, which dominated a lot of the news headlines and fear and everything that went with it. So this was, based on those, everything we could pull together, our outlook a year ago for 2024. Now, I've done this the last several years because I just think it's a good practice to just see where we were thinking and where do we end up. This is not, if we're right, it's not a victory lap. If we're wrong, it's not a woe is me. Really, it's just to try to set a frame of reference for how we should think going forward. So our outlook a year ago today, or close to it, was that we felt that interest rates were going to be lower, but then turn higher later in the year. We felt that stocks would continue to go higher and the bull market would continue. We felt that there was no bubble in sight. That the election year, if you look at historical data, favored stocks performing well. There was large amounts of cash on the sidelines, and that helped our bullish case. And that the artificial intelligence supercycle is still in the beginning stages of a long-term supercycle along the way. Well, if you look at interest rates, this is a picture on interest rates last year. Now, we started the year, this is the 10-year Treasury, we started the year with rates going up, and we thought they were going to go down. Right around late April or so, rates did turn down, and then they did go lower. And so we ended up on a low somewhere close to 3.5 on the 10-year Treasury. That's also around the time mortgage rates bottomed for the year, somewhere around mid-September. And then they pivoted and turned, and interest rates have been steadily going higher since September. So I think our timing was maybe a little off in general. I think we were kind of around there, but that was the thought there. Stocks going higher, the market was up 25%. I didn't see that coming. We had just come off of, a 26% year. I didn't think that we would see another 20-plus return year, but that's why you stay invested. So the market was up 25%. Bull market was still in play. We did not necessarily see a bubble in sight. That never played out. The election year, again, it's another trend that favors stocks. There's large amounts of cash on the sidelines that favored stocks. And then the AI supercycle, those AI names and stocks and parts of the market did very well still. So again, this isn't a pat on the back or, because we don't get a lot of stuff right. It's just directionally, we're just trying to make the best decisions, given the framework of what's out there, to determine how to make investment decisions on behalf of you. So 2024, there we are, 25% gain in the S&P 500, 29% gain in the NASDAQ. The international markets lagged, and for those of you that are clients, you probably noticed we don't have a lot of investments in international areas. That's been by design. That's been like that for a long time, actually. We just feel that the U.S. remains the best investment landscape in the world. That may change in the future, but at least as of right now, it has been our case. And bonds, they were kind of just meandered on, and because of the rate volatility over the year, that's why they didn't really perform that particularly well. All right, so now the question is, what's next? I like to say the easy money's been made. There's not this pounding the table opportunity. Oh my gosh, we got to get money into the market now. We're at all these depressed prices. No, I mean the market's had a pretty good run for 2 years in a row, and in general for probably the last 15 or 16 years. So where are we heading? Before we get there, I want to take a detour and say, I think it's important that you, as an investor, think about the last 5 years. Because the last 5 years have probably been the most challenging, or close to the most challenging, 5-year period of time to make investment decisions. And here's the reasons. We had a global pandemic, and then you have the ripple effects of shutting down the global economy. There was an inflation wave, which we then saw the highest wave of inflation that we had seen in 2 generations, 3 generations, a long time. That was resulting in the fastest interest rate hikes in history. And lo and behold, we have had probably the most contentious and divisive election, at least in my lifetime, but probably in most of U.S. history, and a surprise outcome, where not necessarily the presidential election was a surprise, that was a toss-up, but now having the Republicans having all 3 houses, 2 of Congress and the presidency. So that's been a pretty difficult 5 years, I'd say, to make investment decisions. And here's the point. The point is, if you let emotional responses dictate whether you're invested or not invested or how you should invest, your emotions could have easily kept you out of the market and unsuccessful the last 5 years. And there's an old saying, and I love this concept, that when emotion runs high, logic runs low. And so our job has always been, let's strip the emotion out of things, let's look at data, let's think, and stay within the confines of a strategic plan and how it relates to you, and ultimately, we're going to be rewarded for it. So, quick little detour, now what's next? What I chose to do is to break this into different components, catalysts, effects of the market, and where we're likely to see those impact the market. So let's start with inflation. Inflation, right, this is the last 5 years, and you see this crescendo, basically, of the highest inflation, I think it was definitely back to the 70s, so you're talking 50 years, where we peaked out at a 9% inflation rate. Now, since then, it's been a steadily decrease, and even just this morning, had a good number released. Inflation's still moderating, that's why the market rallied today and had a good day. So the impact of inflation is coming back in line. And what that really means is now inflation, lower inflation does not mean that your prices are going down. And this is something that I think people struggle with. Inflation is the pace of increase. Okay? It does not mean that the bottle of water I purchased today, if inflation is going down, is going to be less in 6 months. No, it just means the increase of that price is slower now than it was. And so prices are not coming down, but what's happening and will happen is that labor and wages will help offset that. So you get this increase of labor and wage improvement at the same time of a slowing inflation. And so that is, and if inflation continues to be tame, is a good thing for the market and a good thing for the economy. If you look at a long-term inflation chart, and I think I've shown this maybe a couple times, but this is as of, recently. You see back in the 70s and early 80s, the peak of those high inflation years, and then there was a steady trend of downward inflation, obviously with some fits and starts along the way. But then we have this exogenous shock right here of inflation. We've talked about the reasons why I won't bore you with. And here we are moderating at a pretty quick pace. And that's important because a lot of people felt that inflation was going to remain high for an extended period of time. Okay? And because of a lot of reasons, but one of the biggest reasons is the pace of increase of interest rates. The Federal Reserve getting aggressive in a very short amount of time really helped pull that inflation number down. And what it's allowing is the Federal Reserve to be a little bit more normal, I guess you could say. So when we look at inflation, our outlook is we think inflation is likely to continue to be tame. We're probably going to get throughout the year periods of time where there might be some number that gets released that's a little higher than expected and the market doesn't like it, etc. But I don't see any reasons why we're going to ramp up and just go hog wild with inflation again. That is not something we see in the horizon. And therefore, the impact on stocks is a positive. So let's explore financial conditions. Now, by financial conditions, what I mean is there's two parts to this. One is fiscal, and one is monetary. The monetary financial conditions are largely controlled by the Federal Reserve. So you have interest rates and the money supply, etc. So let's talk about that one first. Here is, if you're familiar with, if you ever heard the term the Fed dot plot, okay? Here's what that means. All the Federal Board governors, every meeting, are tasked with putting a dot, basically, on where they think the federal funds rate will be at different periods of time. So in other words, here is the dot plot for where the different Fed Board of Governors, the individual members, feel that rates are likely to be the next, 3 years. And this also kind of jives with what the market is pricing in to a large extent. There's periods where that is an imbalance. But this is likely the projection of where the Fed funds target is going to be. Now, why is that important? Well, because the Fed funds target is essentially the base rate that a lot of other lending rates are based off of. It's also the base rate that a lot of other cash deposit and savings rates are based off of. So with this said, we're forecasting, and the Fed is forecasting, there to be a slow, kind of methodical decline in the Fed funds rate. Now, that's a good thing because here's several reasons why. Number one, if you can get a little bit more of a methodical, slower process, and if the Fed believes that's going to be the case, that's usually a tell that the economic conditions are likely to be relatively mild. There's not going to be a lot of, panic mode in different areas. There's not going to be that the conditions are going to be good for business, good for the economy, but we're still going to have to lower rates over time just to be a little stimulative. And we can because inflation is coming down. So that's the mindset of that particular slow slope in rates. What we don't want to see is predictions or indication that the Fed's funds rate is going to have large changes, okay? Because that would potentially indicate that there might be some headaches, economic headaches on the way. So this is a good sign, and it also leads us to think that based on economic conditions, based on inflation concerns, the dual mandate of the Fed, that the Federal Reserve probably can become a little bit more normalized now instead of having to be reactive to these big moves. Now, interest rates, this is the 10-year Treasury rate, which is not a control arm of the Fed. These are the price of federal Treasury bonds, essentially 10 years left to maturity. Well, these are priced based on the market, based on the buyers and sellers. And so what tends to happen is when rates go down on the front end, so the Federal Reserve drops rates, you tend to see, similar moves in these longer rates as well. What's happened, and what has kind of drove some people crazy and caused a lot of questions, is that over the last several months, as we've seen the Federal Reserve lower their Fed funds rate, we've seen a spike in these 10-year rates and 20-year rates and such. So why is that, and what's happening there? Well, let's go into that a little bit. So that phenomena that I just explained, where short-term rates, like the Fed funds rate, which is an overnight rate, the relationship between those short rates and longer-term rates, like 10 years or 20 or 30, the way that those rates are, that's called the yield curve. If you ever heard that term, that's what they're talking about. The relationship between short-term interest rates and long-term interest rates. And a lot of market technicians and economists and everything pay a lot of attention to what that yield curve is doing, the relationship of those rates, because that tends to have a little bit of a forecasting ability on what's likely ahead for the economy or the market. Now, because lower short-term rates are going lower and long-term rates are going higher, you're getting this steepening effect. Now, the steepening of the yield curve can be interpreted by different ways. And I know I'm getting a little deeper. I'm trying to do a little bit of behind-the-curtain education so that as you start hearing things in the financial media and such, you'll at least make some connections. Well, there's two different ways that yield curve can steepen. The first way, and this is more of a bearish way, so bearish would mean that it would predict that the market's going to go down, is when short-term rates are increasing at a faster pace than long-term rates. Or, right, so when short-term rates are going up and long-term rates are maybe not going up as fast or not at all, that creates a steepening, okay? I'm sorry, when long-term rates are exceeding that, that would create a steepening. That is a bearish indicator, potentially. But that's not what we have today. We have what's called a bull steepening pattern, where the long-term rates, okay, they're not really dropping. In fact, in this case, they've been going up. But short-term rates are coming down. So the reason that's good is short-term rates are coming down, meaning that financial conditions are improving in the short term, but there's still projected growth out for the long term. So I know that might have been a little bit deep, but the takeaway is that we are not in this yield curve steepening it's actually a good indicator, a bullish indicator, not a bearish indicator right now. Okay, let's talk about, that's monetary policy. Let's talk about fiscal or tax policy. And so we had an election, we had a winner. Republicans control all three houses of power now. So we don't know what's going to happen until it actually happens. But if you look at proposals, this is back on the campaign trail, let's discuss this a little bit. The corporate tax rate is currently at 21%. Trump has proposed, on the campaign trail at least, a 20% corporate tax rate and a separate lower tax rate of 15% for companies that make their products in the U.S. The capital gains rate or dividend rate, there have been no particular changes proposed to that. The individual income tax rate, if you remember, we were harping on this quite a bit, and it's still in effect, that at the end of this year, the Tax Cut and Job Act will expire. So all of the rates that were under today, the tax rates, which are lower than they were prior to the Tax Cut and Job Act, they will expire and we will revert to higher rates. Had we had an election outcome that was still divided government, whether Democrat presidency, Republican Congress, whatever, that would have been a really, really, really big thing that we're focusing on, because it's unclear whether that would get extended or not. Now, it's still unclear. However, with the Republicans having full control, if you kind of look at all their tax policies, it makes it more likely that those tax cuts will be extended, or at least some variation of them, or similar type of proposals to what is currently the case. So, if you look at what Trump was proposing on the campaign trail, he was proposing to make those cuts permanent. I still don't know how this will work, and I'll cover that in a second. Replacing personal income tax with increased tariffs. Removing the itemized deduction cap on state and local taxes paid. He talked about making Social Security benefits tax-free. The tip income would be tax-free, and overtime pay. Again, remains to be seen what actually happens. History shows that campaign formats and actual policy tend to be different. But we'll see. All right. This was something in our webinar in October, the election webinar I shared, and the reason I say this is to help also build this case of what the financial conditions are like going forward. If you have a tax increase, which is what would have happened or will happen if the Tax Cut and Job Act expires, that has a negative impact on economic growth, because an additional dollar you have to pay in taxes is an additional dollar you cannot spend, thereby infiltrating it into the economy. So there were some studies done, and there actually is a fairly significant impact of a 1% tax decrease, for instance, adds to the GDP about 3%, anywhere from 2.5% to 3% over a 3-year period. The converse is true. If it's a tax increase, the effect to GDP is negative. Okay. Same thing with corporate tax rates. So, for instance, if Trump does put through a 20% rate or even a 15% rate on American companies making a product in America, that has an effect on GDP as well. So, the long and short of that, the financial conditions that are likely to be present in 2025, we see more normalized Fed policy, and we see pro-growth tax policy coming out of the legislature, which is a positive for stocks. Let's talk about mortgage rates. Mortgage rates are obviously dependent on interest rates to some extent. They don't work exactly the same. The Fed funds rate, kind of going back to my point earlier, the Fed funds rate has been declining, but mortgage rates have been going up, and that has confused a lot of people. The mortgage rate is most closely correlated to the 10-year Treasury, so that's why a lot of people watch the 10-year Treasury. But the reason mortgage rates are so important is because what it means for the real estate market, and the impact of real estate on the economy is a very large impact. So mortgage rates over the last 5 years, there's a chart, they've gone up quite a bit. This is a substantial change. And as you've probably heard a lot of people, but what's happened is, well, now, look, if you got a house and a 3.5% mortgage or a 2.5% mortgage, you're probably not moving. So 10 years ago, when mortgage rates were continuing to decline, you might move, hey, there's a nice house that popped up on Zillow across town. I might go over there. That's a really nice neighborhood, etc. Nowadays, if you're going to sell a house and you have a 2.5 or 3% mortgage rate and you want to move across town, you're thinking twice, because now you got a 7% mortgage rate you're going to have. And so your cost goes up substantially. And so the byproduct is people are staying in their homes longer and longer and not selling, which has created a supply issue. If you talk to real estate agents, that's exactly what they'll tell you. So mortgage rates have a big impact on economic growth. So this is 5-year, but if you look at the long term, it's very similar to that 10-year Treasury, where we've seen this long-term, slow drop in interest rate and mortgage rates, really since the early 1980s. Well, if you followed any of our research and such in the past, and I like to look at trends, and we talk about kind of what trends mean and long-term trends, etc. Well, anytime you have kind of a break in a trend, that's usually not a good thing. And in 2022 or 3 or whatever it was, when rates started really popping, we started breaking through this long-term downtrend in rates. And what I think is going to happen is, now we're not going to go straight up. We're not going from a 7% mortgage rate today to 10%. But what I do think is that the next 10 to 15 years are probably a slow grind into a higher interest rate and a higher mortgage rate environment. It won't happen at once. It'll be slow, and there'll be lower rates and higher rates, and all average out. But my point to you is this. One, if you're sitting around waiting to buy a house on a 3% mortgage rate again, I don't think it's going to happen, probably in your lifetime. Now, national average mortgage rate, I think today is 7.1 or something. That's according to where we're seeing rates go, both long rates, mortgage rates, etc. I think mortgage rates will moderate in 2025, closer to 6% or so. And because of that, that's another benefit to the economy. Mortgage rates coming down will mean more refinances, more purchasing, more activity, etc. But I don't think we're going back to 3% rates. And if you look at long-term averages, 6% is not a high long-term average. It's more of a normalized long-term average. Okay, investor flows. What is the impact of investor flows? In other words, where people are moving their money to. A few months ago in the election webinar, I talked about the cash on the sidelines. A year ago, I talked about the cash on the sidelines. Guess what? Today, there's still a lot of cash on the sidelines. We think that investors will continue to allocate cash, since now, again, short-term interest rates are going down, so that deposit rate that they were getting in money market is not 5.25% anymore. Now it's 4.5% or lower, and going to continue to go lower, more than likely. And so what that does is, you have to think about what is something we call real rates of return. And that is, okay, if I'm getting 4% in my money market, but inflation is at 5%, Well, I actually have a real return, not of 4%, but actually negative 1%, right? Because I'm losing the purchasing power of that money. Well, because interest rates and deposit rates have been so high at 5% or so, and inflation had come down to 3.5% the last year, you were actually getting positive real return just by sitting in cash. And a lot of people, including us in some of these portfolios, were using cash and the money market lending deposit rates as almost a bond alternative, because you could get similar or equal returns in cash with no volatility and risk. It's a great deal. Well, those cash rates are coming down. And yes, inflation has come down, but we're going to reach a point where you're going to need to get real return, which is either going to have to be in bonds or equities. And more than likely, a lot of that cash is going to end up more in the equity market. And that's another positive. Now, let's talk about some political implications. So one of the things that you've heard and we've heard from the incoming administration is tariffs. Tariffs are in play. We're going to raise more money in tariffs. We're going to use tariffs, etc. And then the concept of deporting illegal immigrants. Well, there are economic impacts to any of those policies that come about. So let's uncover that a little bit. Now, when we talk about tariffs, basically you're talking about goods that come into the country, placing a very high tax on those goods. And you've heard I've heard Trump say that, look, we used to never have income tax. We used to get all of our tax revenue from just tariffs. Well, I think we should replace income tax with tariffs. And so what he's saying is true, that is true, yes. And this is actually a chart showing what percentage of federal receipts came in the form of tariffs, essentially throughout the country's history. So while it is true, what you notice is really since the mid-1800s is the last time we had a very large, substantial portion of our federal receipts come in the form of tariffs. And since then, and if you look really since late 1940s, tariffs have not really been a significant source at all of federal receipts. It's all income tax. Now, this isn't a political discussion on which is better and what should we have to do. That's for other people to decide. But let's think about, okay, what is the impact of tariffs if, Trump places a high tariff on Mexico or a high tariff on China, et cetera. Well, before we get there, when we're talking about tariffs, okay, this is how the net federal receipts of the government, the sources are coming from right now. And you see almost half of it is individual income taxes. 10% is corporate income taxes. 36% is basically Social Security taxes. Then the other are, fees and customs, and then tariffs would fall into this bucket too. All right. So it's really not a significant source of receipts right now. So to replace the income tax system with tariffs, you're talking about a monumental change in how revenues are assessed, and that would have a really large-scale economic impact. Let's talk about the impact. Well, let's go back to tariffs real quick. Here is my sense. This is little old me. I don't know anything, but just my sense of where the tariff thing's going to land. If we know anything about Trump, these tariffs are a bargaining chip, is all I think it is. And I don't think I included it in the presentation, but I was looking at his last term and kind of the difference between the tariff he was threatening with and what actually happened. And I want to say it was China. He was threatening 45% tariffs or something, and we ended up, I think, a 15% tariff. My point is this. I think the bark is bigger than the bite with the actual tariffs. And that's why I don't know it's going to be a huge implication to economic growth. You also have to remember that Trump is probably the most, he's probably the president who has ever paid the most attention to the stock market. He views the stock market as a barometer of his success as a president to some extent. And so I don't think he's going to impose something that's going to be detrimental to the economy and the market because he views that as a barometer of his success to some extent. So that's just my candid personal thoughts. So I don't think tariffs are really going to get out of control, but I don't know. Let's talk about deportation, which is another political. Trump ran on closing the border and then starting to deport illegal immigrants. Well, that will have if that happens, that will have an economic impact. And so this is just kind of a visual representation of that unauthorized or illegal immigrants, whatever you want to call them, in the top 15 occupations. I mean, they're a substantial part. And so if we start deporting all of these jobs, that there's going to be a vacuum there that's going to need to be filled, and there's going to be an economic impact there. So all that to say is that the tariffs and the deportations and the political part of that, how that affects the market impact, I think is unknown. And I think if implemented in the way that it's being discussed, could and would be a negative for the market. And then we're going to move on to DOGE, which, what does it stand? The Department of something Government Efficiency. I should remember that. But if you're not familiar with DOGE is essentially the organization that is being set up by Elon Musk and Vivek Ramaswamy to essentially root out and find all inefficiencies in government spending and look for waste and save money, which I don't know anyone that's really against that concept. I don't know any. I've never ever on both political sides of the aisle talked to someone that is really thrilled about how the government spends their tax revenue. So you'd think this would be a really embraced idea. So this is something that was posted by, you can follow, there it is, Department of Government Efficiency. So this was posted on Twitter by Department of Government Efficiency. And if you look at the total revenues, right, 4.47 trillion, that was in 2023. Here's the breakdown. We kind of discussed this already, but there's a big deficit there between that and spending. 4.47 was brought in, 6.16 went out, okay? If you or I managed our own households like that, we wouldn't last very long. So they're going to be tasked with trying to figure out, of this spending here, what's wasteful and how can they save money. Now, that's all great, and I'm on board. The impact is somewhat unknown. So if there really is an aggressive stripping of money from the budget, and maybe it is, maybe it's all wasteful stuff, and it all makes sense and it really makes the government efficient, and we save money. That's a good thing, but you got to remember that's also taking funds out of the economy. So when government spending is a part of economic activity, it just is. And so, depending upon how effective and aggressive those cuts may be, that's an unknown. And that could be a negative for the market, to be very honest with you. Okay, moving along. I got to move it along here. Corporate profits. Corporate profits still look good. Kind of going back to some of the tax policy, if corporate rates drop a little bit. Right now, there's also a lot of deregulation that's expected from the new incoming administration. So the climate for business and business profits is still very good, especially if you have tame inflation and your input costs are low. Corporations are likely to do well. That's a positive. Sentiment. Those who have followed us for a while know that I like to look at sentiment, because sentiment is just an indicator of how people are feeling about their investments. And the great thing about that is sentiment can be a very contrarian indicator. So, for example, the Association of Institutional Investors, the AAII, puts out a survey. I think it's every week. And I've shown this before. This is the current survey. And so if you look at the week ending January 8th, we're actually up to a bearish level. Okay, so the question is, are you bullish, bearish, or neutral about the stock market the next 6 months? That's the question they ask. And so depending on how people respond, 37% say they're bearish. Well, that's actually a little high. If you look at the 1 year bearish high down here, we were up to 38%. Now, it's not at extremes. Like if we think back to September of 2022, when the market had been down 20-some%, we were at extreme levels of bearishness, if you remember. We're not there, clearly. However, what we're also not is these extreme levels of bullishness that you see at market tops. And that's important. Here's another look. This is the spread between bullish and bearish responses. So it's that same survey over time. So, for instance, when I said about 2022, look how negative sentiment was. Okay? Now, in retrospect, it's easy to look back and go, man, no wonder the market bottomed then. We should have invested everything we had. Well, remember the conversations that you and I had in those periods, and no one was feeling very good. And so it goes back to saying where the hardest times it is to invest are usually the best times you should invest. That said, where we're at today is we're not at these extreme levels of bullishness. If we get to extreme levels of bullishness, that's a contrarian sign that we may be, right? So look at 2021, for instance, right? Everybody was really bullish kind of towards the beginning part of 2021. And in retrospect, it should have been bearish, huh? So again, great contrarian indicator. This is another measure of consumer sentiment, so not investors but consumers. Again, the story here is that we're not at these peak levels. CNN does a fear versus greed indicator. Currently the level is fear. Okay, this is their chart of kind of fear versus greed, really over the past year. So you can see that we're not at these extreme levels of bullishness. In fact, we're a little bit more on the pessimistic side right now. And that actually might represent some of you as well, based upon how the market started out and been the last several weeks. So the bottom line is sentiment is right now, we don't see extreme levels of bullishness. However, what I could see is towards the middle, part of this year, late part of this year, eventually this 2-year run is going to turn into something that we're going to get a correction. That doesn't mean we sell and want to head for the hills. It just means that we just need to prepare mentally and emotionally for that. So sentiment is positive now. I think it can turn into more of an extreme bullishness and affect us later in the year. Why do I say that? Well, this is it's pretty remarkable. The last 2 years, do not let it become the norm. It's been a great 2 years. And in fact, this chart is showing that the rise in the S&P 500 the last 2 years has been one of the strongest since 1928. So that orange line is the current last 2-year period, okay? And you can see we're way above kind of the top decile and top quartile averages. Now, if you know anything about statistics, right, some of the most basic concepts in statistics are reversion to the mean. And that, you have standard deviation, and if something is this very far-fetched or statistically not likely to happen outcome, that it's not likely you're going to continue to do that. Okay, so keep that in mind. So if you look at, right, so that's the past 2 years' performance. So you may ask, well, historically, we just finished 2 years in a row of returns over 20%. How often has that happened in history, and what has happened after those periods? Well, there's 5 instances and 6th if you go back far enough. And these are instances of the S&P 500 returning greater than 20% for 2 consecutive years. And what has happened is, in all 6 instances, okay, actually 5 of the 6 instances, the second half of that next year was a negative year, or was down. In other words, a challenging second half of the year, right? So you kind of, for instance, you kind of peaked out there. This is the outlier where the second half did really good. You kind of peaked out here. Okay, peaked out here, 96, another outlier, and peaked out here. Now, we could be in the 90s, and if you look at the returns in the 90s, there were some really significant returns. For example, in 1996, after 2 great years in 94 and 95, 96 was another great year. And guess what? 97 was, and 98 was. So we could be in that period. And if you think back to the 90s, that was, the internet, dawn of the internet, the dot-com bubble eventually peaked out, remember, in 2001. So some have made the case that we're in a similar period with AI. AI is the new internet. We're in this kind of super cycle, which I do think we're in. So could the run continue and eventually kind of pop? Maybe, right? And that's why it's important and it's healthy to get these corrections every now and then. Because if we just kept stacking 20% years on 20% years, what's likely to happen is at some point we're going to have a pretty nasty day of reckoning. Whereas if we end up in this bull market where we have good years, then we have a little bit of setback and good years, that's a great landscape for long-term market growth, where you're not going to have these bubbles and such. So here's a visual representation of that. This is this S&P 500 since its lows in October of 2022. And you see this, that we've essentially been in a very clear, defined upward channel, this bull market, okay? And so I guess here's where I'm going with all this. I think this year, the market's going to do fairly well, especially in the first half. Okay? There's reasons to think that. Now, does that mean we're up 20%? I doubt it. Okay? But a good market and not a reason to sell. But at some point, we're going to have kind of that little tipping point and a retracement. And so if you look here, you could easily see how that could happen. Okay? And then, as long as we're still within these trends, the bull market's, it's here. It's not going anywhere. If you have a trend where it breaks through this down market, okay, that's when you may have a little bit more of a long-term troubles. So the bottom line is that we don't see that in the picture. We don't see a break in the bull market in the picture. I think 2025's, and I'm just going to wrap it up now, even though I got a couple more slides. well, I'll just do this. So I don't see a break in the trend. 2025 should be a good year. It's probably not going to be the great years that we've seen. I think it's time to be more prudent and judicious about what you own. The easy money's been made. Internally, what we're doing is we're really thinking through and looking through asset allocation. We have been strategically more equity focused the last few years because of our bullish case. It's worked out well. And it's time to really think through rebalancing and re-strategizing. One of the takeaways that I'm going to leave with you is that, we really want to make sure periodically that we are in line, for you who are clients, not all of you are clients on this call, but that we're in line with not only your goals from financial goals and all the financial planning we're doing, but with risk and risk management as well. And so one of the things you're going to start receiving from us is we're going to update your risk tolerance. We're going to give you essentially a questionnaire and make sure that how you feel about your money is in line with how we're investing your money. Because what we don't want to do is we've had these great years and everybody's happy and markets are great and I think it's been a huge success. But we want to make sure we're prudent and disciplined. And the times to do that are not when the market's going haywire. The times to do it are when, okay, it's been a few years, we have some good markets, let's make sure I'm in line. So I'm going to leave it there. Thank you all for joining. There will be a replay of this available on our YouTube page. Just go to YouTube and type in counterweight. I think it's on our website too, the YouTube page. If not, maybe we should get it there. That said, thank you for the time you spent with us. 2024 was a great year, and I'm really looking forward to 2025. We as a firm have a lot of exciting things that are kind of in the picture for 2025 that we look forward to sharing as we go. If you have any questions, reach out to us. And that's all for today, and we'll see you next time. Thanks.